Hello everyone, here is the quiz review video for your quiz on long-term managerial decision making, which is chapter 26 in Pearson. What we're going to have here is a company which has two alternatives and they're mutually exclusive, so you have to choose one or the other. Our company, Littell Company, has two options for expanding its operations. Under Plan A, they will open 8 new smaller stores, and under Plan B, they will open only 3 stores, but they're much larger. They have the important information as follows about both plans. Plan A, opening 8 small stores, is going to cost $8.6 million up front. And if they do this plan, they expect to generate $1,625,000 in cash inflows each year for the next 10 years. And at the end of the 10-year life of this project, there is no residual value. Under Plan B, the cost up front is going to be $8.3 million. They expect an annual net cash inflow of $1 million per year for the next 10 years. At the end of 10 years, they are going to liquidate part of this. So the interiors of the new stores they're opening, something they're going to be able to sell at the end to get $1.2 million in residual value. They're going to use straight line depreciation for all of their assets, which we're going to have for our calculations. And this company requires a 6% rate of return on all projects it undertakes. So they have to get a return of 6% if that's what they're going to approve. Well, let's go through and do some decision-making models to help us decide if Plan A or Plan B is better. The first one we have is payback period, and it's simply how long is it going to take us to get our money back if we invest in this plan. So for Plan A, we have an initial investment of $8.6 million. That is our cost up front. The inflows from Plan A are $1.625 million, and they're regular inflows, which means it's the same amount every year for the whole entire life of the project. And since we have those regular cash inflows to find our payback period, we simply divide our initial investment by our annual net cash inflow. And it comes out to be rounded off 5.3 years. So if this company undertakes Plan A, it's going to take them 5.3 years to recoup their initial investment in the plan. For Plan B, the initial investment is $8.3 million. It is expected to generate annual net cash inflows of $1 million a year for the next 10 years, which means that it's going to take 8.3 years for them to recoup their initial investment. So Plan A pays back much faster than Plan B. The next thing we can find is our accounting rate of return, and this is the percent of return that the company gets if they don't take into consideration the time value of money. So even though, for example, under Plan A, we're getting $1,625,000 each year for the next 10 years, we're going to treat all of those as though they're exactly the same. And what I'm saying is we're not going to put priority on returns during the years immediately in the future and discount the returns that are farther down the life of this project, year 9 or year 10. We're going to treat them all as though they're equally valuable, not concerned about the time value of money. So for ARR, our accounting rate of return, the first thing we need to do is take our average annual operating income. And to do so, what you do is you take your inflows and you divide it by your annual depreciation expense. So our inflows are given in the problem. For Plan A, it's $1,625,000 a year. For Plan B, it's $1 million per year. And we need to divide that by our annual depreciation expense. Well, we already learned earlier that we're going to use straight line depreciation. So to figure out how much depreciation we will record on all of the assets that we're going to use to, undertake these new stores, we would use the straight line formula, which is just cost minus residual, gives us our depreciable base divided by the project's life. Because it's straight line, we're going to take an equal portion away each year. So for Plan A, it's an $8.6 million cost with no residual. Well, if we take that $8.6 million depreciable base and divide it by the project's life of 10 years, we get $860,000. For Plan B, historical cost would be $8.3 million, and it has a residual value of $1.2 million, which means our depreciable base is the difference between those two numbers, $7.1 million, and when we divide that by the 10-year life of the project, we would depreciate $710,000. Using the straight line method each year. So our annual operating income is just our cash inflows, which we can think of as our revenue, minus our annual depreciation expense. For Plan A, we're going to have $765,000 in annual operating income, and for Plan B, we're going to have $290,000. Well, we need to divide that by our average investment. And what our average investment is essentially the amount of cost we have put into the project on any one given day for the entirety of its life. So what you do to find this, the easiest way is figure out what the value of the project is on its first day and what the value of the project would be on its last day. So for plan A, day one, we're going to invest $8.6 million into this project, and we're going to slowly depreciate it over its 10-year life until at the end it has a residual value of 0. Well, if you take your historical cost, add to it your residual value, you're going to get a subtotal. And when you divide that by 2, it's going to give you your average investment. If we're worth $8.6 million on the first day and 0 on the last day, we add those two together, divide by 2, we get our average investment in inventory for plan A, or our average investment in this project, for plan A of $4.3 million. For plan B, do the same thing. Take your value on the first day, which is your cost, $8.3 million. Add to it your value on the last day, which is your residual value, $1.2 million. Gives you $9.5 million in total. When we divide that by 2, our average investment in plan B is $4,750,000. So we can fill those numbers in. And then to find our accounting rate of return, we divide our average annual operating income by our average investment. So $765,000 divided by $4.3 million means that plan A has an accounting rate of return of 17.8%, and plan B has an accounting rate of return of 6.1%. Well, we required a 6% investment off the get-go, so both of these make that requirement, though plan A looks much better than plan B. Another metric we can use is net present value. And net present value is the most commonly used metric that we have for managerial decision making because it takes into account the time value of money. Take plan A, for example, that $1,625,000 we get each year. Well, the payment that we're going to get, the inflow we're going to get in year 1, is worth a lot more than the one we're going to get in year 10, because we don't have to wait 10 years for it. We can do things with that cash inflow that we're receiving from the project. So for NPV, we're going to have to discount cash flows coming in the future because they're not worth as much to us in today's dollars because we have to wait longer for them, and therefore we're foregoing the opportunity to use that money that we invested in something else. We're going to use the same information we had before, and again, this company requires a 6% rate of return on all capital projects. Well, the first thing we need to do is we need to find the present value of all of our cash inflows. So our annual inflow, let's start with plan A, is $1,625,000. These inflows are the same every year, and they're paid in regular intervals. We're getting $1.625 million annually for the next 10 years, and because it's the same amount each year, and each inflow is at a regular interval, that is by definition an annuity. So we can figure out how we're going to discount these inflows by using the present value of an ordinary annuity factor. And to do so, we need to find the intersection that goes for the life of the project, number of periods, and our rate of return. The number of periods, the life of this project for plan A is 10. Our required rate of return is 6. So if we find the intersection of those two numbers on our present value of an ordinary annuity table, we get 7.360. And then when we take our annual inflow, multiply it by our present value of an annuity factor, we get an NPV of our cash flows of $11,960,000. So those 10 cash inflows of $1,625,000 a year for the next 10 years, when discounted for the time value of money, have a present value of just under $12 million. We also need to figure out what the present value of our residual is. For plan A, our residual is 0. Because this is just one lump sum that we're receiving 10 years in the future, we're going to use the present value of one table. And to use the present value of one table, you're going to do the same concept. Find the intersection of how many years in the future it is until you get this cash inflow and what your required rate of return is. So 10 years until we receive our residual times 6% is 0.558. But since our residual was 0, 0 times anything is still going to be 0. There is no net present value of our residual because there is no residual. We add those two together, we get our total present value of inflows, $11,960,000, and from that we subtract our initial investment. Our initial investment in plan A was $8,600,000. When we subtract that from our present value of all inflows, we get the present value of plan A. Plan A is worth $3,360,000 in today's money. Let's do the same thing for plan B. The annual inflow from Plan B is $1 million. When we multiply that by our present value of an ordinary annuity factor, again for the intersection of the life of the project and our required rate of return, it's still 7.360. The present value of those future inflows is $7,360,000. Plan B does have a residual, and that residual is $1,200,000. So we go and we find the intersection of the life of our project and our required rate of return on the present value of one table, and it's 0.558 still. When we multiply that 1.2 million times 0.558, the net present value is $669,600. So yes, we're getting $1.2 million 10 years in the future, but because we have to wait so long, it's really only worth to us $669,600 today. If we add those two together, we get $8,029,600. That is the present value of all cash inflows we're going to get from Plan B over its life. And when we subtract our initial investment of $8.3 million, we see that in today's dollars, if we undertake Plan B, we're going to actually lose $270,400 on this plan. Profitability index is basically a measure of how much profit are you going to turn based on your initial investment. And all you need to do is take your present value of all your inflows and divide it by your initial investment. So the present value of all of our inflows for Plan A was $11,960,000. For Plan B, it was $8,029,600. And we divide that by each plan's respective initial investment. We're going to get the profitability index. For Plan A, it is 1.39 million, or 1.39, I'm sorry, which means that we are going to return essentially 139% of our initial investment in the form of inflow. So we're making more money because it's above 100% than our initial investment. That's a pretty good return. For Plan B, we're going to put in $8.3 million to get $8,029,600 worth of inflows. Our profitability index there is 0.97. That means we're only going to get 97% of our initial investment back. Plan B is no good for profitability index perspective. Lastly, we have our estimation of our IRR, and this is our rate of return when we take into consideration the time value of money. And the calculations to do this are mind-bogglingly hard. Next up, we have to estimate our internal rate of return. An internal rate of return is essentially what is your expected rate of return when you take into consideration the time value of money. Doing the calculations for this is not pretty at all, so I'm going to just let you estimate it. And to estimate it, it's simple enough. You need to have your payback period and you need to have the life of the project in years. So both of our plans have 10-year life, and Plan A has a 5.3-year payback period and Plan B has an 8.3-year payback period. What we're going to do to estimate our IRR is we're going to find on the number of periods row where our payback period lies between percentages, and that's kind of confusing sounding. I'll make it easy for you. Plan A has a 10-year life, so we go down and we find the row where our number of periods is 10, and we go over until we find the number that is closest to our payback period, which is 5.3. And as we see over here, the numbers that are closest to our payback period is the 5.650 in 12% and the 5.216 under the 14% column. So our internal rate of return has to be somewhere between 12 and 14%. For Plan B, again, has a life of 10 years. So we're going to go down until the row where periods equals 10. And we're going to go over until we find the two numbers that 8.3, our payback period, lies between, and that is between the 8.530 under the 3% column and the 8.111 under the 4% column. So our internal rate of return for Plan B is somewhere between 3 and 4%. Through all of these estimations that we have made, we see that Plan A is just superior to Plan B. So what should we do? We should do Plan A, which is to open the 8 smaller stores.